The stock market is in a bubble. Seriously, this thing is blowing more than Annabelle Chong. Google that. But I don't think it's going to pop anytime soon. And I'm here to tell you why.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul. Now, I am brand new to investing and this channel is all about me learning a lot about the stock market. And today I've learned a lot about bubbles and why they might or might not pop. There is a lot to come in this episode and a lot of it focuses around this man called Jamie Dimon. Jamie Dimon is a guy who, I can't work out how old this guy is. He's seriously, in every single picture, he looks a different age. In my head, he's always looking like this late 40s, early 50s kind of dude. He's a good looking lad. But then in some pictures, my God, he just looks like he's 80 or even 90 years old at some point. But Jamie Dimon, we seem to love him because he swears a lot and he has a lot of opinions. He's often right about a lot of things, but he is also wrong a lot as well. And right now, Jamie Dimon is predicting that we could have a massive boom going on into 2023. And he's not just saying that, he backs it up with his research from his company JP Morgan in his guide to markets. And this is the Q2 2021 section. This is a guide that I look forward to every couple of months because there is so much data in here. It tells you so much about the state of the current markets. If you just read it, it's an 82, 83 page document. But I'm going to quickly go through this and show you some of the highlights and the things that might influence my investing going forward. The stock market, as in the S&P 500, is in a bubble. I hate to tell you that, guys, but it is. There's just no doubt about it whatsoever. That doesn't mean, though, that I think the bubble is going to pop tomorrow and there's going to be a massive market crash. I still think there's plenty of money to be made in the market, and I can see where it's coming from when I just listen to a few people and I have a look at a few of the stats. Jamie Dimon seems to agree, although he can put it much more articulately than I can. So due to lockdowns and lower spending, we have millions of people now with hundreds of thousands of pounds stuck in their bank accounts, ready to spend. Jamie Dimon predicts that there's 2 trillion coiled and ready to go back into the market as soon as we all get free again. And how does Jamie Dimon know this? Because he holds all the money. He knows that in the last year, less loans have been taken out at his bank and deposits in bank accounts have jumped more than 24%. So he knows that this money isn't in investments and it isn't getting spent. It's sitting there in cash accounts. And this money is about to flood back out into brick and mortar retail, into travel and general consumerism. And this isn't based on absolutely no data whatsoever. JP Morgan have recently released its guide to the markets, which has so much information in it. First of all, I just want to show you how overvalued the S&P 500 is right now. What's interesting to see is that the average 25-year PE ratio has now gone up to 16.64. And that's up slightly from what we would consider a normal PE ratio as 15. But it's also worth noting that the only time the forward PE ratio has ever been over 20 was the tech bubble. So we are hitting those sorts of valuations at the moment. We're not at tech bubble valuations right now, but there are a lot of things that are creeping in which really do make this look a lot more like the tech bubble. However, it is worth noting that when the tech bubble did burst, it went from 24 times earnings down to about 20 times earnings. Because in 2002, that's essentially when the tech bubble kind of finished. That was the sort of bottom of the tech bubble. But the forward PE ratios of stocks still continued all the way down, all the way to 2008. And in that time from 2002 all the way up to 2017, you saw a 90% return on the S&P 500. So PE ratios going down isn't necessarily a bad thing. Prices can definitely still go up while PE ratios revert. What happened during the tech bubble was that a disproportionate amount of stocks had a considerably high amount of money in them. There was around 10 stocks which all made up around 20% of the S&P 500 and the rest was all in brand new IPOs. Does that sound familiar at all anywhere? And while these massive tech names crashed and their forward PE ratio all contracted right down, the S&P 500 still went up in price. This is because of that famous mean reversion that I was talking about, and stocks that weren't so exuberant during the tech bubble tended to do very well on the recovery. So this would be my first bit of evidence to say that in the long run, buying high quality, high cash flow companies which are still undervalued is a very good way to work in the stock market. And the divergence in the sectors right now is not very healthy. All the different sectors should all be traveling up in the same direction at the same time. Just some sectors should be doing better than others. And the sector spread right now is not very healthy. All of the sectors should, in a good market, be traveling upwards together. Fair enough, tech and hypey stuff should be doing better than the old cyclicals. I totally get that. But they should not be at complete odds to each other. During the pandemic, it shows that the grey shaded areas did considerably better than the green areas, and the green areas are doing a lot better now versus the grey areas. And the big winners of the tech bubble were online retail and home improvement, which is what we saw. And the losers were all oil, airlines, retail REITs, and hotels and cruise lines. But now going into 2021 with all the vaccine news, it's just completely flipped. And this is not healthy. Cathie Wood describes this as a very healthy way the market should go, as in it's like bringing together that K market a little bit. But this does indicate that this is a big bull market still going on, and a reason why I will continue to invest going forward. The trouble is the S&P 500 acts like a step. It always goes a little bit sideways, and it goes up, a little bit sideways, goes up, and then goes sideways again. In fact, between the years of 2000 and 2010, the markets went super sideways. And previous to that, the massive bull market that went on between the 1980s and 2000 lasted about 20 years. This could indicate that the current bull market that we've got going on from the year 2010 to 2020 might only be about halfway. So it could be that based on these trends, the bull market could continue another 10 years. That is one hell of an overvaluation going forward, and it's going to be a killer of a recession when it comes. And while Jamie Dimon is very bullish on the US and the Western world going into 2023, if inflation occurs, there is a bit of a story as to where our money might be best placed. And let's face it, inflation is coming. In all three occasions where inflation occurs, emerging markets reign supreme. This is almost always followed by REITs, except for the high and rising inflation where growth will do very, very well as well. But there's no doubt the overall winner in the long term is emerging markets, which is quite an interesting stance to take. Only in low inflation or even deflation would it be that emerging markets really start to fail and growth really does stand out here. So your high growth, high tech stocks will be the winners in this occasion. In fact, on average, just for safety, you could say that buying into both growth and value over the long term could be the best strategy. However, a good chance of getting high returns will be to bet on emerging markets such as China, India, and South Korea. And there's no better man to explain this than Stanley Druckenmiller. Stanley Druckenmiller is quite a big trader in commodities, but most famously, this guy who looks like he's trying to sell you a used car has never lost in the market. He's had 30 years of positive returns. There's no one that I know of who's better than Stanley Druckenmiller at trading macroeconomics. And this is what Stanley Druckenmiller thinks about the future.
The next 5 years or so, Asia looks a lot better to me than the United States, because at some point, we got to pay back in terms of productivity, in terms of higher rates, in terms of a lower dollar for all these transfer payments we've made the last 9 months, and it looks like we're going to continue to make.
Stanley Druckenmiller is saying that the US has simply borrowed and printed too much money and Asia didn't. And in that simple way, while China and India aren't going to take over the US in any significant way going forward, they will probably grow quicker. So it's very important not to ignore the emerging markets going forward. A lot of the US investors will ignore emerging markets. There's no doubt about that. US investors tend to only invest in the US, whereas us in the UK and in Europe, we tend to think a little bit more outside the box. We go to the US for our tech and our high value, We'll also then consider big companies over here like Rio Tinto, Prosus, and ASML. And then we'll also have a look and see what the emerging markets are like as well. What's going to keep the big bubble inflated is the 10-year treasury yields. These goddamn treasury yields that everyone has been banging on about for the past couple of months. It's very simple. Treasury yields here in 1981 would have been an excellent place to put your money. While everyone else in 1981 was paying 15% on their mortgage, if you had a bit of cash in a bond, you were getting 15% a year of their payments. This is mad. Our current money printing climate has been going on so long, I find it really hard to get my head around 15% treasury yields and 15% mortgages. But it could happen again. And it's just a good thing to remember for the future. My parents always talk about how they remember their mortgage rates being about 15 to 20% and how they were always really struggling to pay their mortgage and they were really scared that they were going to lose their house. But it's worth remembering, once mortgage rates start to go up, it also means that savings rates and saving interest will also go up as well. Right now though, this bubble is nowhere near popping. 10-year treasury yields are super low still. I know we've been having this little inflection to 1.7% recently, but I think treasury yields would really need to come up past 5% before people would start thinking about withdrawing all their shares from Tesla and then banging it into income. That is very possible, but it's not happening right now, and it's a reason why I think things are going to stay the same for probably about 5 years. On page 50, we start to see how good some of these emerging markets companies are becoming. Emerging market corporate bonds are getting very high quality, going all the way from B+ all the way up to BBB- right now. Emerging market corporate bonds are now becoming seriously investable. Just a little side point here, it's showing how good the UK is at getting vaccinations out. I don't know if this is a good thing now. To think that the UK is so far ahead than anybody else in the world at something, other than probably Israel, to think that we're so far ahead of everybody else has got to be a bad thing, right? We're doing something wrong. We're cutting some corners, right? Maybe that's just the British way of thinking. It's going so well, something has to up pretty soon, right? JP Morgan are going really hard on showing just how good the emerging markets are going to be in the next 5 years, showing that by 2030, 72% of China could become middle class. India as well, growing 79% into middle class. That means there's going to be a lot of consumerism coming out of China and India, and it is going to lead to a different way of life. There are a lot of rumors that a lot of Chinese millionaires and billionaires are leaving China because they are scared of how the government treats them. So this is going to lead to a multitude of different outcomes. It's mostly going to revolve around a lot of consumerism and a lot more freedom, probably with a sprinkle of civil war. There's more emerging market good news here, with this orange line showing that China is vastly outpacing the US in technological progress. But it's also not spending as much to get this progress. The difference between their technological progress versus their technological spending probably shows a lot about how China works. Moving away from emerging markets now into alternative sources, there's some very interesting data if you're looking into REITs. According to US real estate vacancy rates, it's a very good time to be in industrial REITs such as big box warehouses and manufacturing warehouses, and it's also a very good time to be in apartment REITs as well. However, it's a very bad time to be in office star REITs, so you might want to consider that going forward, especially with the work from home stuff coming out at the moment. Innovation and technology, which JP Morgan is very much behind, shows some things which I think we should already know. Electrical vehicle sales are growing exponentially. That is a very good sign, particularly in Europe, showing quite a good uptake. And in fact, in 2020, less in the US. That's a very interesting figure, but overall we've got exponential EV sales. And also down here, we've got global semiconductor market growth. This is a huge section going forward, and this is going to probably grow exponentially as well as we have more EVs, as we have more global clean energy. Semiconductors is obviously going to be a massive part of the future. Going forward, JP Morgan always puts in this famous graph which shows every asset class returns for the past 20 years. As usual, REITs lead the way with 11.6% of average returns over 20 years, followed by high yield. High yield doesn't mean dividends, I don't think. It's mainly high yield corporate bonds, so junk bonds. A really good example of that would be Netflix right now, which is actually considered as junk bond status. But then again, Netflix has a pretty poor credit rating and isn't cash flow positive yet, so that would be the risk that you have for taking out high yield bonds. Coming in third and fourth are small caps and emerging markets equities. So these are two very important sectors that we kind of need to discuss going forward in the future. This one actually includes FTSE AIM, which I'm sure a few people in the comments would love to know. S&P 500 next at 6.1%. 6.1% is what the S&P 500 has returned over the past 20 years. So everyone thinking that is 8% and 10%, it's not. It's 6.1%, and you need to remember that going forward. And down here we have 2.5 here for the average investor. This average investor isn't the sort of investor that you think of where you buy these high quality companies and just let them grow. The average investor tends to lose money because they're buying and selling all the time. If you're into SPACs, stay in SPACs. If you're into high growth, stay in high growth. If you're into value, stay in value, because the worst thing you can do is keep switching in and out of all the different asset classes as you are chasing all the stocks that are going up. That will do you far, far more good in the stock market than keep switching around and trying to buy Tesla when it's high and try and sell it when it's low. Just buy, hold, continue, cost average. And finally, I just wanted to touch on this pension return assumptions. This is a very interesting one for me because I know I've told you before that I don't have a pension, and there are a lot of reasons for that I'm still building up and I'm still trying to convert into a coherent video right now. But I always look out for this detail in the JP Morgan Guide to the Markets, because this is so important to me when showing how good a pension really is right now in comparison to all the free money that you get. State and local governments, while this isn't the UK specifically, the story is very similar in the UK. State and local government pensions are considered as defined benefit pensions. These are the pensions that I have access to in the fire service and in the NHS. And long-term data is showing that these pension returns are diminishing. This has me worried that in 20 or 30 years, defined benefit pensions are going to be at risk of defaulting. There simply doesn't seem to be enough money to pay for all the old pensions and continue to pay for all the new pensions as everyone retires. But that is a story for another day. I will get around to that one day. I just want to really give you a good outline on this. And to be honest with you, you should never say, oh, I'm not going to have a pension just because Briscoe says. This is very personal to me. It's a very personal decision, and I don't think you should follow it. I don't think the majority of people should not have a pension either. That should be a very, very personal decision that you come to on your own basis. I don't know what I'm talking about now. So that's JP Morgan's Guide to the Markets. That is where I also see the economy going over the next couple of years. At least till 2023, I think we're going to be on a massive bull run. And I do think that high quality, high cash flow companies are going to be at the forefront of that, or at least make a really good return in that at a good margin of safety. Thank you very much for watching, everyone. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. If you sign up through that link, you can get a free share that's worth up to £100. And I also get a free share as well. I also use eToro to buy my Bitcoin and Ethereum. If you wanted to sign up through that, you really helped out the channel. Just remember that cryptocurrencies and everything are really volatile, and everything that I said could have been just full of shit. Please feel free to continue the conversation by leaving a comment below or joining the completely free Discord, where we have loads and loads of different conversations about different stocks, different cryptocurrencies. It's really, really interesting there. Loads of people have got different ideas, and there's a lot of really good and well thought out conversations in here that really do make you think about different ways of investing. Also, feel free to check me out on Instagram, where I post lots of pictures that I think look like penises. Has anybody else noticed how phallic the Blue Origin rockets look? They really do look like penises. Well, kind of looks like mine anyway. But I'll also post up little tidbits of information that I find out there on Instagram and out there on different websites, like this one, which shows the activity of all of the meme stock frenzy since January of 2021. Where you all gone, guys? Where you all gone? Check out the purple line of activity of Robinhood. It's really dropped. It's a really good sign that a lot of investors are starting to get a little bit bored of investing. Thank you very much for watching, though. And if you enjoyed this video, please feel free to like, subscribe, and invest. Ooh, little burp in the end there. How did that happen? That's a present for you.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.